Okay, so I should stress from the beginning that the book is very much about monetary value and how it focuses in the economy rather than other kinds of value, ethical or aesthetic or the like. And I'm going to be arguing that monetary value is of central importance to how the economy works, or at least the marketized section of the economy. I've argued elsewhere, in particular in the other book that Steve mentioned, Profits and Gifts in the Digital Economy, that the marketized section is not the only important section of the economy, but it is that section I'm going to be focusing on today. And I'm going to be suggesting that value is very important, but in quite a different way than the ways that we're accustomed to it being talked about. Here is, no, maybe not. Here's a quick overview of what I plan to talk about. I'll say a little bit about the book itself, and then pick up on some core themes from it. I'll start off talking a little bit about issues that engage with the previous literature on value, and I'll be critical about some of the earlier theories of value or approaches to value. And then I'll start to develop a more substantive theoretical framework, which I will apply to the issue of explaining the determination of prices for commodities. And having gone through that, I'll then move on and talk a bit about the financial side of the equation, in particular, the valuation and pricing of financial assets. I'll also touch a little bit on what some of the implications of this argument might be from a critical perspective and from the point of view of what critical realism might be able to contribute to developing economics. So that's what I'm doing. Let me get right down to it by talking about what's covered in the book. The book's basically in 3 parts. The first part engages with previous traditions of work on value. The second part develops my own argument, which draws to some extent on the previous part, because I don't just dismiss previous approaches to value completely. I also highlight some useful work that's been done in our traditions, for example, by Keynes and by the French tradition of economics of convention. And then the third part applies this model to 3 cases from the financial sector in particular. I'm not going to say much about that today. I'm going to concentrate a bit on the first part and more on the second part. I'll say a bit about how the theory applies to financial assets, but I'm only going to look at one of these cases as a way of illustrating the argument. Okay, so that gives you a little bit of perspective on what I'm planning to do tonight. So let me begin by saying a little bit about that first theme, which enables us to talk about previous approaches to monetary value and their understandings of what value, monetary value, actually is, and what's problematic about that. So I'm going to contrast 3 existing views, 2 in particular, and then go on to talk about what I want to assert myself. First one being the approach that, as I'm sure you're all aware, is pretty dominant in economics today, which is very much based on kind of neoclassical marginalist theories, where value is not a word that is used very much, but when it is used, it's assumed to be the same thing as equilibrium price, the price of a commodity that's achieved when demand and supply balance. And there are huge numbers of problems with this kind of neoclassical theory of markets and prices. And I'm sure that most of you are familiar with many of those problems already. And I discuss a number of them in the book, but I want to just pick out one here, which is perhaps not widely discussed, which is that there's a kind of ontological problem with, it's both an ontological and a methodological problem with the neoclassical approach, which is that despite all of the pretensions of mainstream economics to be scientific, it's not actually a theory that explains actual events. The theory of equilibrium price is the theory of an idealization. The vast, well, we can argue about what proportion, but a large proportion of commodity exchanges do not occur at anything that remotely resembles an equilibrium price. If we want an explanatory theory, a scientific theory even, of what determines price, we need to be explaining what determines the actual prices that things exchange at, and not what determines these kind of imaginary, semi-imaginary equilibrium prices of economic theory. So a theory that tries to explain something that doesn't exist, in my view, is not particularly useful. And it's, in a way, it's not intended to be useful. It's intended to be, well, that's putting it a bit too strongly, perhaps. This whole framework is part of an ideological system for justifying market systems rather than an explanatory system for explaining actual events. So there are lots of reasons, including that one, for dismissing the approach to value that we see in mainstream economics. Traditionally, the main alternative to that theory of value has been the Marxist tradition, and in particular, Marx's labor theory of value, which says that the value of a commodity is determined by the amount of socially necessary abstract labor time embedded somehow in the commodity. Again, there are lots of problems with that. Problems I've discussed in the book, problems I discussed in my previous book, problems that have been done to death in the literature. And again, I'm just going to pick on one issue, and that is that, again, there's a kind of ontological problem with Marx's labor theory of value, which is that, again, what it explains, depending on whose perspective you take on it, but generally what it explains is not an actual empirical event. It's not actual prices that things change at. It explains something abstract and ultimately imaginary. And in a way, what it reduces it to is that the labor value of a thing both is and is determined by the quantity of socially necessary abstract labor time embedded in it. And so that doesn't seem to be saying anything very useful. Can it be used to explain something that actually is empirical, such as price? Well, we could debate that, but let's not go into that. And the other problem with this theory, well, one of the many other problems, is that the theory seems to require that value is somehow embedded in commodities. The difficulty with the labor theory is that if we want to relate value to price, then price is something that is determined at the time of exchange of a commodity. And yet the amount of labor value appears to be determined at the time of production of the commodity. So somehow the labor value has to be embedded in the commodity so that it can be carried forward in time to a point where it has some apparent influence on events. But labor doesn't work like that. Labor doesn't get embedded in the products of its work. Labor is a process. It may does generally alter the things that it operates on, but it doesn't get embedded in there and preserved in some way that can be influential in the future. I mean, there is a way in which the amount of labour time can influence the price that's paid for a thing, and which is that it's part of the cost. You know, for the business, they have to pay a cost of labour, and that then has an effect on the price that they need to charge or feel they need to charge for it. But of course, that's the theory that Marx is trying to replace. You know, he doesn't want labour to be just one more cost. He wants it to be something special. And again, that's an ideological argument, but an argument that's, in this case, designed to undermine the case for market systems. Let me just more briefly say a little bit about more recent work. One of the difficulties is that the work that's embedded in these two traditions has warped the discursive environment around questions like these, so that even when people produce more innovative approaches to value, it's difficult to shake off the residue of those earlier approaches. And a nice example is the concept of value creation and value extraction, which we see, for example, in the book of Mariana Mazzucato about value, which I like in lots of other ways, but she gets pulled into this trap of value creation and value extraction, which rests on exactly that same problematic issue that's come across from Marx, the idea that value is somehow embedded in a commodity and it flows through a system, and then some time later on it gets extracted, which isn't really tenable. So instead of any of those kinds of argument, the argument I'm developing in Inventing Value comes back to a much more mundane, everyday understanding of what value is, and that is just the sense of what something is worth, what would be a fair or reasonable price for it. Now, that might seem underwhelming at first because it's so much less ambitious at first sight than those theories that we've grown up with. But once we've rejected those theories, we need to think about monetary value a little bit more modestly, a little bit more realistically, and think about how it operates in the explanation of actual events. So I'm going to talk about that in a minute, but I worry that for some of you, this idea that a theory of monetary value should do more than that is rather deeply ingrained. So let me challenge that a bit more explicitly before I go on to my alternative. You see, the thing is that both mainstream and Marxist theories of value don't just want the concept to provide an explanation of some set of economic phenomena. They want it to explain the entirety of how the economy works. And then also on top of that, they want it to provide the basis for an entire ethics and politics of the economy. The neoliberals use the kind of idealized neoclassical theory of equilibrium price to demand the marketization of the entire economy. The Marxists use the idealized labor theory of value to demand the abolition of capitalism. So both of them are demanding an awful lot of a theory of value, but in both cases, these political conclusions that they're trying to reach towards, in my view, rest on the fact that these are ethically influenced ideological systems to start with. You know, we don't start with an explanatory theory and then derive a political conclusion from it. In both of these cases, the ethical prejudgments are smuggled into the so-called explanatory argument very early on. Now, I want to be clear that I'm not opposed to social science taking an ethical or a political stance. On the contrary, I think that's an important part of what we do. But serious thinkers can't base their explanations of how things work on how they would like things to work. They can't base their explanations on how things work on their political objectives. We have to understand how things work, and then we can combine that with an understanding of our ethical values and political objectives to talk about what conclusions we think that should lead us to. But that then leads us to be explicit about those values and objectives rather than smuggling them in the first place. So I'm suggesting that theories of value should be for something a bit less directly politically ambitious than those previous frameworks. And instead, they should be explanatory theories of how commodity exchange operates, or in particular, I'm going to suggest of at least part of what contributes to the determination of prices. And the argument I put forward starts from this recognition that value is, in practice, what people think a thing is worth, and that commodity transactions just can't take place unless sellers and buyers have a view of what this thing is worth that enables them to come to an agreement about price. So every participant in the market has a view on what the commodities that they're interested in are worth. That's quite subjective, it might seem, but and in that sense, it might look a bit like the neoclassical preference theory, but I want to immediately explain why that's not the case, because when people form their judgments of value, they do so under the influence of a whole normative context, a whole set of theories or conventions or norms about how we should assess the value of a commodity. I call those lay theories of value. The concept of valuation conventions comes from the economics of convention tradition, and I will use them interchangeably, but there may perhaps be some subtle differences. And whatever we call them, these things are norms of a kind. They're norms about how we should determine what things are worth. And let me give you a few simple examples to help make clear what I'm talking about. I mean, there are thousands, I suggest, of these norms, these conventions. For example, number one, the price of something should be lower if it's damaged. That's a very, very simple norm about how we value things, and it's one that probably most people would agree with. Second example, the price of something should be higher if it costs more to produce. I mean, obviously, sellers who expended those costs think that, but most buyers accept it as well. Third, maybe slightly more controversially, the price of something should be higher if it's an indicator of high social status. You may or may not agree with that, but I think it's hard to deny that that is a very powerful norm that does influence the prices that are achievable for many, prestige commodities. Those are all quite simple, quite everyday. Let me give you an example of the kind of an illustration of the breadth of the concept by looking at a much more complex example. And this, in this case, I'm going to move into the economy of financial assets, and that example I want to give you is the theory, the convention that the price of a financial option should be calculated using the Black-Scholes formula developed in financial economics. That is a convention about how to value something. It's not actually a current convention anymore, but for perhaps 10 years, that was the prevailing convention as to how commodities traders, not commodity derivatives traders valued financial options. So I'm suggesting there are an awful lot of these conventions. And that leaves a lot of space for debate about how things should be valued, and a lot of work that is done by social actors with discursive power to try to influence which valuation conventions we adopt and which valuation conventions we think should apply to this case or that case. The politics of valuation, in other words, dominated by actors with discursive power, actors like advertisers, marketing departments, media businesses, who are constantly striving to influence our notions of value. All the adverts we see for fancy goods, if you buy, the well, we used to call them the broadsheet papers, the posh papers. They're all stuffed with adverts for expensive goods, trying to persuade us to value them as prestige items, for example. Okay, so let me then start to look at how that functions as part of a way of explaining how prices are determined. So price in the sense of the price is actually paid in an exchange transaction is an event. And as a critical realist, I consider that every event is caused by a complex of interacting causal mechanisms. Now that already takes us beyond, the neoclassical idea of an equilibrium price that in a sense ought to be paid in all transactions in the markets at any given time. Once you give up that understanding of prices, you have to give up the notion that there's one price across the market and instead treat the price paid in each transaction as a separate event with its own unique causal explanation. Those causal explanations, though, often have a lot of factors in common, and the explanatory challenge is to identify the kind of classes of factors that are involved and how they interact to produce individual pricing outcomes. Those factors include some that have often been used in the neoclassical framework. It may be true, for example, it probably is true that in many cases, firms will withdraw from markets if they can't cover their costs of production, and supply will go down, and that will create pressure on prices. But even though that as a mechanism is something that I think we can pull into a wider theory, that doesn't mean that we have to reduce the explanation of prices to the intersection of demand and supply curves to produce an equilibrium. Some of those mechanisms they talk about need to be there in a theory of price, but relocated into a different explanatory framework where they can also be combined with other kinds of mechanisms. So I've given a little bit of an overview there, and I'm going to try and make that clearer by building up a picture that describes a rough explanatory model of how price is determined. So let's go to the first version. So I'm going to give you 4 versions of this picture, and every time I click next, it's going to add some boxes to it, or some circles, or whatever shapes are involved. The blue circles are economic actors. They could be individuals or corporate actors. These ovals are outcomes, events. The realized sale price on the right is the thing that I'm going to be explaining. I'm going to ignore lots and lots of things, obviously. I'm just going to try and focus on the bits that help to make sense of the theory. I'm going to give you one other little bit of context to the diagram, which is that one of the things I've ignored is that here in this arrow here, I don't want you to think that I believe that one event here is causing another event. Obviously, having formed their valuations, buyers and sellers are also then involved in a process of perhaps negotiation or other decision making that leads to the sale prices. So this is not just events to events. There's always a case of social entities with causal powers interacting to produce the next event in the chain. So at the simplest level of the argument, buyers and sellers each have their own valuations of the commodity that's involved in the case, and they interact with each other in order to agree a price. In some cases, they will actually negotiate. In other cases, one will set a price and the other one has to take it or leave it. But in cases like that, the sale doesn't happen unless the buyer accepts the valuation of the seller. So both of the valuations interact before we can get to an actual sale price. So there's level 1 of the diagram. Level 2 brings in those things I've been talking about already, which take us back a step in the causal chain. So these green boxes are normative structures. On the one hand, we have valuation conventions. Both buyers and sellers refer back to valuation conventions, theories of how things should be valued to determine how to value the commodity at issue. And there's another bunch of norms that I've introduced here called application narratives. I've alluded to them already. There aren't just norms about how to value things. There are also norms about which valuation conventions should apply to which things in which circumstances. The norms that you apply to buying, I don't know, a second-hand car are different from the norms that you apply to buying a lettuce in the supermarket. And we all understand, or most of us understand, what the differences are between which norms should be applied in which cases. But those are norms, and they're kind of socially agreed. I'll come back to them in a minute. This doesn't mean I should stress that each valuation is determined by one valuation convention. This is perhaps a difference between me and the conventions theorists. You tend to see one convention being dominant in any particular case. It's certainly possible that the buyers and the sellers have different conventions that they're trying to apply. The seller might say, this should be valued highly because it cost a lot to produce, and the buyer might be saying, this should be valued low because it's damaged, just to use the examples we've talked about. But also, it's not just the case that each party only bears in mind one valuation convention. If something is damaged but a prestige item, still just sticking to the examples that we've used already, then both of those will interact in the buyer deciding what they're prepared to pay for it, for example. Okay, let me then move on to level 3 of the diagram. Level 3 introduces 2 sets of things. Really, it introduces some of the things that the neoclassicals tell us are relevant. So the cost structures affect what sellers decide they think they're willing to accept for an item, how much of it they're prepared to produce at a given price, even perhaps. So that, in a way, that combines with a valuation convention. It's not just that the cost structure is there and that determines the price. The cost structure influences what price the seller believes it's reasonable for them to demand. And to be honest, there's another line that feeds from the cost structures into the buyers, because again, if the buyers understand cost structures, that will influence their view of what is a reasonable price to pay. The availability levels box is just intended to say, well, there are other things that we hear about in the theory of supply and demand that may also be relevant. But the second set of boxes that's introduced here is the capacity of goods to meet needs at the top and the theories of needs in the middle. So both of these relate to the capacity of a commodity to meet the needs of potential buyers. And that recognizes some comments made by Andrew Sayre in a review article in the book in Contributions to Political Economy. So clearly, one part of what motivates a buyer to value a product is whether that product, well, what product can do for them, right? And that depends on physical characteristics of the product. It also depends on the physical characteristics of the buyer, and there are some quite generic things, we all need to eat and drink, if you're hungry and a good can sate your hunger, then that is going to influence your valuation of that good. But in most commodity markets, in most contemporary societies, there's another level of complexity, which is that if I want to buy a food item, I'm not just influenced by the physical need to sate my hunger. I'm also influenced by a whole set of views about what kind of food, for example, I need to eat. And that side of our needs is socially influenced. There are norms about it. The things that I would choose to eat are probably different from things that someone from a different culture would choose to eat to meet the same physical need. So there's another normative side of what influences the prices we're prepared to pay. Then finally, on level 4 of this diagram, I'm going back behind these normative boxes, the norms about needs and conventions and which conventions should be applied, to say, well, how do those norms get shaped? And in generic terms, I've argued elsewhere that behind every norm there sits a group of people called a norm circle, a group of people that endorses a particular norm or a particular version of a norm, and perhaps enforces it in their interactions with each other. And so generically, each of these norms has a group like that behind it, but those groups include self-interested actors. And in particular, in the book, I highlight self-interested actors I call value entrepreneurs. So people who want you to buy a certain kind of commodity, typically because they produce it and profit from you buying it, strive to influence these normative factors. They strive to influence what kind of things we think we need. They strive to influence how we think they should be valued, which conventions should apply to their commodities. And the people who sell Rolex watches want us to believe that it's important for us to display status. That's a need, isn't it? That Rolex watches are incredibly exclusive and expensive to make, and therefore that we should value them on that basis, and that then feeds into the valuations that we're willing to make when it comes to buying a Rolex watch. I don't wear a watch at all personally, so I'm not talking about myself, but this is an environment where norms are not neutral. Norms are shaped and influenced by actors with specific material interests in shaping the normative environment in a way that works to their benefit. Okay, that's all I want to say about commodity valuation. But let me move on and say a little bit now about how this argument applies to assets. Okay, so the asset, a lot of what I've said about commodities applies to value assets as well, but some things are different. I mean, perhaps the most obvious thing that's different is that financial assets, aren't going to help you when you're hungry. You know, they don't have any material benefits to the user, to the purchaser, but their utility, if you want to use that word, depends entirely on the revenue, you know, that you may be able to obtain from an asset in the future. And that revenue stream is highly uncertain. So, you know, how is it that people make decisions about what's a fair price to pay for an asset when the future revenue stream from that asset, the future income that you might obtain by selling that asset, is inherently uncertain? You know, that's a problem that a bunch of people have engaged with, notably John Maynard Keynes. And as I said before, don't I say this? Well, I said I was going to refer to him. Keynes's idea of conventions, which he developed to address this issue, is one of the inspirations of the whole French tradition of economics of conventions. So Keynes, in effect, you know, I'm jumping ahead to another slide now. Keynes, in effect, said that to resolve this kind of uncertainty, we fall back on conventions about how we should judge the value of financial assets. And Keynes had a couple of them. The one that he actually used the term for was that he said, well, we agree to assume that things will continue as they are, which is rather vague, actually, because there's lots of different ways in which things could continue as they are. You know, a company could continue to pay a certain dividend every year, or you know, the amount of revenue that they can raise from a customer could stay the same from year to year. Lots of things could stay the same, and choosing which one we're going to base our valuation on is taking us back to choosing a valuation convention. So there's a knowledge problem involved in valuing financial assets, but actually there's two knowledge problems involved. And the second one is that most potential investors, you know, by contrast with the kind of neoclassical assumption that every agent is open to transacting in every market, in reality, most potential investors are completely unaware of the very existence of most potential investments. There are millions of things out there that you could invest in, and most of us don't even know that most of them exist. And even when we do know that they exist, we're not convinced that there's something for us. And so the possibility of selling an asset depends on having a bunch of people who know that that asset exists, and that it's something that they think is worth investing in. And you know, because neoclassical economics assumes away that problem, it doesn't have a need to solve it. But I'm suggesting we do need to solve it, and the way to solve it is with a concept that of asset circles. You know, so I'm saying that the value of a financial asset, I just said this already, really depends on there being people who would be willing to purchase it at some reasonable price, and that group of people or other economic actors, institutions, organizations, is what I call the asset circle for the asset concern. You know, for every asset, this was a central point of my paper, by the way, that was circulated as advanced reading. Assets need audiences. Assets aren't really assets at all if they can't be sold, and they can only be sold if there's a group of people who would be open to consider buying them. And the number of people that's open to consider buying something is very pertinent to whether or not it has value, how much value it has. And so value entrepreneurs in the financial asset space don't just go around trying to persuade people to use a certain convention to value their assets. They also go around trying to persuade people that they should think about buying this kind of asset or this particular asset at all, because most of us never did think that that was something worth thinking about. Now, this is illustrated heavily in the book with the case studies. I'm just going to quickly run through key points from one of those, which is the case of venture capital. Okay, so venture capitalists are in the business of raising funds from other investors, insurance companies, sovereign wealth funds, family offices of super rich individuals, and using those funds to buy a stake in what I'm going to call portfolio companies. So portfolio companies are companies that are in the venture capitalist's portfolio because they've bought a stake in them. So they buy a stake in the company, and then they try to increase the value of their stake and sell it at a profit. And the kind of obvious part of how they increase the value of the stake is that they try to help the company to grow, maybe give them advice, help them to invest in things that are going to grow the revenues and so on. But the other part of the process is that they build the asset circle for the company's shares. And we can see that operating through the different stages of the venture capital process. In stage one, before the venture capitalist has even invested, the managers of the portfolio companies come to the venture capitalist, they show them a business plan, and the objective of the business plan is to persuade the venture capitalist to seriously consider investing in this company. So they're trying to grow the asset circle by bringing the venture capitalist in. Stage two, if a company grows successfully, then it will need more capital, and the venture capitalist goes out and it leads more funding rounds in which they go out, and now the venture capitalist tries to persuade other venture capitalists that this company is worth investing in. Then collectively they put more money in. So they've expanded the asset circle again. And then in the most successful cases, which is quite a small minority, they decide that they can launch this company, this portfolio company, onto the public stock exchange in an IPO, an initial public offering. And to do that, they recruit people called underwriters, who mostly work for the big investment banks. And the underwriters go out and they pitch to institutional investors, some of the same ones that we talked about earlier, sovereign wealth funds, insurance companies, and try to persuade them that they should buy shares in this portfolio company when they're released onto the public stock exchange. So, and we could go on to stage D as well, but the point is still the same. At each stage in the process, what the venture capitalist is doing is trying to expand the asset circle who believe that this company is worth investing in as a way to raise the value that's achievable for its shares. Okay, can I go slightly quicker through the next one because I've already said a fair bit of this. So our value entrepreneurs are trying to expand the asset circle for the assets they're interested in, but they're also trying to persuade us to use particular valuation conventions. A nice example of that is the internet stock bubble that occurred around 2000. And that rested really on the acceptance by quite a broad community. Sorry, I think I've accidentally. Yeah, okay. That rested on the acceptance by quite a broad community of an innovative valuation convention. And the convention was this, that if a company was attracting a lot of users to its internet site, then that meant that the company was worth more, regardless of whether those people were actually providing any revenue to the company or not. regardless of whether, in fact, it was costing the company money every time somebody visited their website. This was known, colloquially as the eyeballs convention. The more eyeballs you attract to your website, then the more your internet business is worth. And that meant that a lot of companies went out there and spent a lot of money on attracting lots of users to their websites, money they didn't really have, but which investors provided to them. And that led to the shares of those companies being valued ludicrously highly until the internet bubble burst in 2001, when people realized that this convention wasn't actually leading them to make investments that were likely to pay out in the future. So valuation conventions operate for financial assets as well. Okay, so that pretty much concludes the substantive part of my argument. I suppose those of you with any kind of background in sociology will recognize that what I've been talking about is two words that appear in the title of the book, is a story of social construction. That the monetary value of commodities and of assets is socially constructed. It depends on discourses and norms about how we should value those things. But social construction is often given quite anti-realist connotations. I want to stress that this is very much a realist version of social construction theory, which recognizes that social construction isn't some sort of mysterious byproduct of impersonal forces like discourse or language, but actually that these values are actively constructed through the self-interested actions of powerful economic actors. Let me then finish just by reflecting on a couple of possible implications of what I've said today. First of all, let me say a word about the political implications. The politics of finance is currently dominated by two factors. First of all, the enormous power of the finance sector. A, to invent financial asset value, to inflate asset values in ways that don't necessarily relate to real earning potentials of productive businesses, and secondly, to shape government policies in their interests. And then the other major factor is the kind of whole neoclassical market discourse of mainstream economics that's used to legitimize government backing for the finance sector by treating the incomes it generates as a measure of its social value. Now, there are lots of reasons already to question that discourse, but this book provides another one by showing that the values achieved by financial assets don't at all reflect their contributions to productive investment. Instead, they're significantly a product of the work done by value entrepreneurs to massage the ways in which we value these assets. And as a result, they suck in vast amounts of capital that could arguably be used for other sorts of purposes with more social value. And the implication of that, I think, once we add in some values about what is important, is that we need a significantly different kind of financial system. Because I'm running out of time, I will move on to my other implication, which is that I think it's worth reflecting on the implications of a project like this for economics and what critical realism or social ontology might be able to contribute to it. I think the first thing that's important is that this helps to make the argument that we need to break down disciplinary boundaries around erected by economists, but people in all disciplines erect disciplinary boundaries. But it seems quite clear that if there's any merit in this argument, that sociological factors have to be considered as part of economic explanations. This isn't a bit of sociology off to the side of economics. This is an argument that says, well, fundamental economic questions are majorly influenced by sociological forces, and we can't have coherent, convincing, complete explanations of economic phenomena that don't take account of sociological factors. And I could just repeat the same statement and substitute the word ontological for sociological too, because in the story, there are ontological hypotheses about asset circles, for example, and normativity, that are important parts of the argument too. So that also leads on to some points about the contributions of critical realism to economics. I mean, clearly, critical realism is not strictly disciplinary in the same sort of way as many other approaches to economics. So it already contributes to the first thing. But the other is that, and here I'm perhaps trying to prompt a response from someone who's in the audience. It seems to me that critical realism can't just confine its interest in economics to questions of ontology, that we need to combine attention to ontology with attention to explanatory theory, and the two are complementary and often the most productive way to develop one is to do it in dialogue with developing the other. That this story I've been telling you has some ontological hypotheses in it. I've just said asset circles and the like. And those emerge from engaging with the explanatory issues. And at the same time, the sorts of explanations I've been offering emerge from thinking about the ontological context of normativity in particular, that shapes the behaviors that I've been interested in. So I think that critical realism needs to go beyond just looking at ontology and to get involved in explanatory work as well. Okay, I'm going to stop there, and thank you for your attention, and I look forward to your questions and your comments.
Great, thanks, Dave. Thanks for a very interesting and provoking talk. I'm sure